Welcome to the Tradespotting video on Bitcoin versus Corona and the path to safe haven. Does coronavirus have the potential to flip Bitcoin from a risk-on asset to a safe haven asset? How did gold become a safe haven asset, and could Bitcoin follow a similar path? Are we in the beginning of an inflation crisis, and what effect would this have on the price of Bitcoin? Is all that glistens gold? These questions and more answered in this episode of Tradespotting. So is Bitcoin a safe haven asset at the moment? Well, a casual browse of YouTube videos will return endless results extolling the benefits of Bitcoin over cash due to inflation. But it's a common mistake of naive traders or analysts to assume that when inflation bad, Bitcoin good, but that's not the whole story. Sure, it's a great asset to rotate cash into if you live in Zimbabwe or Venezuela and suffer under hyperinflation, but Bitcoin isn't going to buy your bread, and it certainly won't be buttering it.
Currently, Bitcoin follows traditional stock markets with a high degree of correlation. You can see from these charts that when the stocks pump or dump, so does Bitcoin. You don't even need to look closely to see that it's true. Let's zoom in though and see what's been happening recently. So far, the coronavirus has caused the biggest drop in company values since 2008. For two-day records, you have to go back to the late 80s to find worse, something few people would ever want to do. Let's take a look at how the carnage unfolded. First reports of the virus came amid the strongest 3 years in stocks and shares for a decade. The Dow and S&P were making record highs. Despite the American-Chinese trade war, Brexit, refugee crisis in the Mediterranean, the Syria conflict prompting World War III headlines, and our impending suffocation due to nitrous oxide and carbon dioxide emissions while we drowned in water from freshly melted icebergs.
At the same time, around 60% of the world's population lived under dictatorships or non-democratic regimes, the worst it's been since the last time a short arse tried to conquer Europe. This calamitous environment had only dampening effects on the world economy due to financial stimulus provided by the Federal Reserve in America, the European Central Bank, and the Communist Party in China. So, if the world economy was standing up to these threats, then how could a virus with a fatality rate less than the seasonal flu have such calamitous effects? And what aspects of world production are vulnerable to its dangers? To see that, we'll have to take a closer look at the prevailing economic environment.
World production had been increasing year on year by between 5.4 and 3.1% since 2010, but this increase had been decelerating. The US trade war, ostensibly with China, but in reality with even its closest economic allies, was slowing output worldwide. Chinese GDP growth, the largest driver of the world economy, was slowing from 6.6% in 2018 to 6.1% in 2019. Reuters reports that some analysts now predict this to fall to 0% in the first quarter of 2020. The next great economic hope, that is India, doesn't yet match the factory output or manufacturing capacity that China was losing.
But all this and the dangers we mentioned earlier seemed secondary to the endless financial stimulus pumped into the system by the world's largest trading blocs. And while there may never have been greater inequality between rich and poor since the Dark Ages, none of that seemed to matter when all you had to do to get rich was open a tracker on the S&P 500, sit back and watch the money roll in. Interest rates had been so low for so long that borrowing was essentially free, and return on investment seemed guaranteed. The world's economy is a web of interdependencies. While there may be different nation states, each with their own agenda, and there may never have been such disparity between the haves and have-nots. It is in nobody's interest to see an economic disaster. So the financial stimulus was cranked up again and again and again until it became the norm.
In 2018, the US spent $276 billion, or 1.75% of GDP, pumping stocks and relieving debt. The Chinese had released over $500 billion via tax cuts, loans, and direct injections. And the European Central Bank was delivering a stimulus package via bond buying program worth over $30 billion every single month. But these are not the only players in the market.
Many intelligent people saw all of this stimulus as a counter to true productivity. The price of gold and other safe haven assets were rising to near all-time highs, signifying a lack of belief in the market and a lack of confidence among investors. The climate emergency was beginning to affect stocks and shares. On January 14th, 2020, BlackRock, the world's largest private equity firm, announced they would transition to carbon-free or environmentally sustainable investments. Icebergs were melting, polar bears were becoming internally displaced refugees, and the coastlines, home to 80% of us, was predicted to be submerged within the next few generations. The world was on the brink of change. All this financial stimulus was predicted to have a terrible effect on the rate of inflation. And with Bitcoin having a clear and predictable rate of inflation, it seemed that there was a high potential for it to flip from a risk-on asset to a safe haven asset. But then came coronavirus. At first it seemed to cause only a minor sneeze in the markets. After all, it had a fatality rate of less than the seasonal flu and only existed in one Chinese province. So how could it have any effect on the world's largest companies that were already doing so well in the face of all this other doom? While China's GDP was slowing, it was still predicted to be over 6% in 2020 before the virus struck. Well, you might have heard the phrase, the market needs confidence. You'll have never heard the phrase, the market needs endless money. And while quantitative easing does provide endless money doesn't address underlying productivity issues. Endless money sounds great until you realize the structural issues it causes and how, in distributing it through institutions rather than individuals, is very unlikely to lead to an equal distribution among society. The reason for this is because people with lots and lots of money don't generally take risks to make more. They don't need to, they already have all the money they need. And so risk erodes their confidence, and instead of spending, they bunker down. And there were big signs of risk coming from China. They are neither a transparent or fair government. They have been locking up religious minorities in re-education camps, aka concentration camps, for years. They flood international markets with cheap subsidized commodities, and they steal intellectual property from every firm that has access to their market. Investors prefer to operate in free markets controlled by democratic societies. This is because they know that non-democratic regimes and the nature of them mean that they must focus their strength to protect their systems of power, which does not lend itself well to dealing with large-scale concerns, particularly health concerns, which could even become an existential threat to these closed, oppressive regimes. When that regime is the economic engine of the world economy, investors hear the sneeze and run for the hills.
The The sneeze turned into a cold at the start of February when it became apparent that China had arrested and persecuted Dr. Wen Lang, the first doctor to warn of the impending crisis. He was trying to save lives. China was trying to cover up the scale of the disaster until the holiday period boosted their economy. The method of transference was not known. The rate of infection was spiraling, and both the death rate and the recovery rate of the disease seemed far too far apart and very unreliable. Much was not known of corona's effects. Would it kill as fast as MERS? Would it cause birth defects and deaths in unborn babies at the rate of SARS? Who was the most vulnerable, and would we all get sick at once, overloading health facilities across the productive Northern Hemisphere during winter?
With no other option, China decided to lock down the province of Hubei. They did this between February the 2nd and February the 7th, around 2 weeks after the start of the Lunar New Year, which was also about 2 weeks too late because 8 million people had already left the area. As this unprecedented lockdown came into effect, Dr. Wen Lang, 34 years old and in the prime of his life, died from COVID-19 caused by the coronavirus. On the 8th of February, we discovered it was rapidly spreading to other areas in China. Despite assurances of openness, journalists who filmed body bags and queues at hospitals were quickly disappeared. Nothing was getting better. As this unprecedented lockdown came into effect, Dr. Wen Lang, 34 years old and in the prime of his life, died from COVID-19 caused by the coronavirus. Nothing was getting better. Despite assurances from the Chinese government of openness, journalists who filmed body bags and queues at hospitals were quickly disappeared. Authorities warned that people became infectious before they started displaying symptoms. This meant you could catch the virus from even seemingly healthy people. At this point, investors realized nobody was safe from infection. Every factory, every office, every school, even as we'll see, every politician was vulnerable. The unknowns were increasing, and while China quickly built a couple of hospitals and further tightened restrictions on movement and extended the holiday period by a couple of weeks, friendly countries started closing their borders, and the Chinese had to ban short selling, which killed the liquidity in the market. The world's manufacturing hub was running out of face masks and running out of toilet roll. None of this breeds confidence, and all of it leads to a slowing in production. As we said, the world's economy is deeply interconnected. Your iPhone may be designed in California, but it's built and put together mostly in China by companies like Foxconn, who dominate the production process and the supply chain. Foxconn stopped production, they closed their factories and they sent their staff home. Deadlines were missed. Product launches were delayed and then delayed again, and then earnings were revised down.
Apple, recently the world's largest and richest company, took a hit of 21% in a week, moving percentage points in just minutes. The Fed announced a further 50 basis point cut to interest rates. This is the deepest cut and the first emergency intervention on interest rates since 2008. Japan announced the first confirmed case of the coronavirus on January the 15th. South Korea did the same on January the 20th. On the 31st of January, 2 people in Rome were found to have the disease, COVID-19. And on January the 31st, 16 cases were found in Lombardy region of Italy, and much of the area was locked down. On the 25th of February, Iran's health minister appeared on TV to minimise panic, but was clearly unwell from the virus himself. This reminded many people of Saddam Hussein's deputy famously extolling the strength of the Baghdad defences as American tanks rolled behind him on screen. On the 26th of February, Switzerland announced its first case, and was soon followed by every Western European nation. On February the 29th, Scotland, the world's greatest small country that brought us the Enlightenment and the world's biggest leaps forward in medical science from penicillin to Dolly the sheep, announced its first case. Where will it stop? Nobody knows.
All this considered, it becomes quite clear why investors felt that their money was at great risk, and why they took it out of stocks and shares and put it into stores of value. Could Bitcoin pivot to become a store of value? The definition of a store of value is an asset that holds its value when others drop and is easily transferable. The world's most popular store of value is not gold, cash, assuming you don't suffer under hyperinflation a la Zimbabwe. So en masse, huge amounts of stocks and shares were sold, millions of dollars of collateralized debt positions were liquidated, and planned investments were delayed or cancelled outright. This is bad news for risk-on assets like Bitcoin. When the proverbial hits the fan, you're worried about your family's health and you need cash to survive, you tend to stop making speculative investments, happening or no happening. Satoshi Nakamoto envisaged Bitcoin to be a store of value when he first created it, but this has not been the need it has fulfilled. Bitcoin banks the unbanked. Killing them off with a virus will do nothing for the value or the utility of Bitcoin. That being said, there are reasons due to Corona that could cause the price of Bitcoin to rise. While cash is king in a recession, gold provides an efficient frontier, raising potential profits without increasing risk. How did gold become such a popular portfolio hedge, and why is it a safe haven asset? Remarkably, when we abandoned the gold-backed dollar, it seemed the end was nigh for our glistening friend. Back then, few predicted it would become a store of value, and even fewer predicted it would be going strong to this day. So how did it make its way back into our plans and our pockets?
In 1968, you could get as much gold as you liked for $39 per troy ounce. By 1980, that had risen to $615. The decoupling from the dollar meant gold's intrinsic value was now able to function as a hedge against inflation in the dollar. So began its journey to becoming an efficient frontier, rising in price by over 15,000% in a decade.
The reasons for this were in part due to two smart brothers who tried to corner the silver market and America invading Afghanistan. But the main cause was the reduction in oil supply in the 1970s due to the creation of OPEC, a cartel of oil-producing nations that got together to fix supply in order to manipulate the price. This caused massive inflation in America, and ever since, gold has been used to hedge against inflationary risks. The main factor driving the price of gold during this upswing was inflation. Between 2008 and 2011, gold went through a further upswing, though the cause was not inflation. This time, a nervous economic environment rooted in toxic debt was the cause, namely mortgage-backed securities, collateralized debt positions, and credit default swaps. Huge amounts of these toxic assets were held by Western financial institutions, completely undermining their balance book and putting many of them at a threat of collapse. This collapse would have caused a change in the world order, and so gold was used as a hedge against this geopolitical risk of a collapse in the current world order. So now gold has proven itself twice, both as an excellent hedge against inflation and an excellent hedge against geopolitical risk. So if we take the price of gold to be an indicator of the health of the world's economy, what is it doing now? Well, it's trending up, and at the beginning of March it was at near all-time highs of $1,670. It's still operating as a hedge, so all is not well with the world economy, but we already knew that. With all this in mind, and if inflation cranks up and geopolitical risks emerge, do you think that Bitcoin will flip to a safe haven asset? How big an opportunity might this present for Bitcoin holders? And what specifically might prompt this change? It starts with an earthquake, birds and snakes, an aeroplane. There are many anecdotal scenarios in which Bitcoin demonstrates its value in anonymity and transportability. For example, you're only allowed to take £10,000 cash when leaving Britain on an aeroplane, and if you're one of the lucky few people in the Congo with any cash at all, you'll know exactly what I mean, because you're not allowed to leave with any of it. In 1967, you weren't allowed to leave Britain with more than 50 quid, which rather restricts holidays and puts a bit of a dent on the odd escape plan. If lockdowns continue, then Bitcoin has these advantages in its favour. It's non-confiscatable, you can own it anonymously, and you can transport it discreetly. Despite still being a nascent technology, there are many potential developments ahead that could lead people who might otherwise never have bought Bitcoin to getting some. Reading headlines such as Iran to release 54,000 prisoners immediately does make you think, what next for Corona? What next for Bitcoin? If you're a believer and you wouldn't leave her, plop your comment down below on why you think Bitcoin is a good hedge against a fragmenting world economy, and maybe I'll include it in a future video on this topic. Check out the channels I've linked below for more on Bitcoin and Corona, and if you want my absolute best tip, then search Rocky Outcrop on YouTube for professional daily Bitcoin and altcoin analysis. Like this video, I'll make better ones, subscribe, you'll be around to see them, and if we're both still alive, I'll see you in the next one. I've been Jamie, this has been Tradespotting.